Why so many IPOs are being quietly delayed right now is not because companies suddenly stopped wanting to go public. It's because the rules of going public have changed in ways that make waiting the smarter move. What looks like hesitation on the surface is actually a calculated pause driven by valuation pressure, investor behavior, and a market that no longer rewards uncertainty. For years, IPOs followed a familiar pattern. Strong growth, compelling narratives, and favorable market conditions made public listings the natural next step for ambitious companies. Going public was framed as a milestone of success. But today, that milestone has become riskier, more scrutinized, and far less forgiving. As a result, many companies that appear ready on paper are choosing to delay quietly rather than fail publicly. The first major reason behind these delays is valuation mismatch. Private markets and public markets are no longer aligned. During the low interest rate era, private investors were willing to fund companies at aggressive valuations based on future potential. Those valuations became internal reference points for founders and early backers. Public markets, however, now demand profitability, predictability, and clear paths to cash flow. When these two valuation worlds collide, the result is disappointment. Companies realize that going public today could mean accepting a valuation far below their last private round, and that kind of downshift is hard to justify. This gap creates a psychological and strategic problem. IPOs are not just financial events, they are reputational ones. A weak or underwhelming public debut can define a company's narrative for years. Executives know that once a company goes public, every quarterly result is judged against expectations set on day one. If those expectations are anchored to a lower valuation, the upside feels limited, and the scrutiny relentless. Delaying becomes a way to protect long-term perception. Another critical factor is investor selectivity. Public market investors have become far more cautious. They are no longer chasing growth at any cost. They want stability, margins, and business models that can perform even in uncertain conditions. Many companies preparing for IPOs are still in transition. They may be growing, but they are still refining unit economics, reducing burn, or proving repeatable demand. In today's environment, almost ready is not good enough. Rather than face rejection or lukewarm reception, companies are choosing to wait. Market volatility also plays a major role. IPOs require a window of confidence. Even strong companies hesitate to go public when markets swing unpredictably. Volatility makes pricing difficult, dampens investor appetite, and increases the risk of poor post-IPO performance. Companies know that a bad market week can overshadow years of preparation. Quiet delays allow them to wait for calmer conditions without signaling weakness. There is also a structural shift in how companies fund themselves. Staying private has become easier. Large private equity firms, sovereign funds, and late-stage investors are willing to provide significant capital without the pressures of public markets. This removes urgency. If a company can raise private funding on acceptable terms, there is little incentive to rush into an IPO environment that feels hostile or uncertain. Regulatory and compliance burdens further discourage premature listings. Public companies operate under constant scrutiny, reporting requirements, and legal exposure. When market rewards were high, these costs felt manageable. Today, when valuations are compressed and investor patience is thin, those same costs feel heavier. Executives are asking a simple question: is the trade-off worth it right now? For many, the answer is no. Another overlooked reason IPOs are being delayed is internal readiness. Going public forces discipline. Forecasts must be precise. Governance must be tight. Internal systems must withstand public scrutiny. In an environment where forecast accuracy matters more than optimistic projections, companies are realizing that being early is dangerous. Delaying allows them to strengthen operations, improve margins, and build credibility before stepping into the spotlight. Importantly, many of these delays are intentional and strategic, not reactive. Companies are learning from recent IPOs that struggled after listing. High-profile examples of stocks that fell below their offering price serve as cautionary tales. Executives see that public markets are unforgiving to companies that miss expectations, even slightly. Waiting becomes a way to learn from others' mistakes without making one of their own. The silence around these delays is also deliberate. Announcing a delay can signal weakness. Instead, companies adjust timelines quietly, citing market conditions or strategic review. This keeps options open. It allows them to move quickly if conditions improve, without having publicly committed to a specific date. From the outside, this creates the illusion that the IPO market is frozen. In reality, it is selective. Only companies that meet stricter criteria are moving forward. Others are regrouping, refining their stories, and preparing for a market that demands substance over hype. There is also a broader shift in how success is defined. For a long time, IPOs were treated as validation, Today, survival, resilience, and sustainable cash flow matter more. Some companies are realizing they do not need to go public to succeed. Others still plan to, but on their own terms. So why are so many IPOs being quietly delayed right now? Because the cost of getting it wrong has risen sharply. Because public markets are demanding proof, not promises. And because waiting, in this environment, is often the most disciplined decision a company can make. When the next wave of IPOs finally arrives, it will likely look different from the last one. Fewer stories, stronger fundamentals, lower tolerance for ambiguity. The delays happening now are not signs of fear. They are signs of recalibration. And in today's market, recalibration is often the smartest move available.